Hello everyone, welcome to our brand new chapter 3. That is all about financial statements, balance sheets, income statements, cash flows, and taxes. From our first chapter, we have understood that the ultimate goal of a financial manager is to maximize shareholders' wealth. How a manager can increase shareholders' wealth, meaning they need to increase long run stock price. Then how long run stock price will be increased? That actually depends on firms' future cash flows. But how financial managers actually decide that which actions are most likely to increase those future cash flows, or how do investors actually estimate that future cash flows of particular firm, their invested firm will be increased? So answer to these questions actually depends on how you study financial statements of that company. Managers actually are encouraged to take those financial decisions that actually enhance long-term value of the firm and pay less attention to the short-term performance of a company, kind of accounting performance such as operating profit, earnings per share, and current ratio, something like that. So um, to understand all of these managerial decision makings that are going to increase shareholders wealth, we need to study our the company's financial statements very carefully, because financial statements, this is kind of statement of a company's financial standing for a particular time period, and which conveys a lot of information about the strength and weakness of the company and operating potentials, future prospect of the investment opportunity, and how the economic well-being of a company will continue throughout the time period. And it also be very helpful that the new initiatives or new investment project, how it will add value to the existing projects or operations. And basically by looking at financial statements, you can easily analyze that, okay, this company is this size, meaning company has more assets, or company hold more cash, or company has more financial debts, long term debts or short term debts, or less equity, or out of total assets, how much finance from banking source, private source, or how much finance from public source, like a bond issuance or equity issuance of the company. So these all we can know by analyzing financial statements. So before that, we just need to understand what financial statements actually contain. So financial statements actually contains four items, four parts. Number one, balance sheet. Second, income statements, owner's equity, and statement of cash flows. And we will also discuss some related topic like free cash flow, FCF, economic value added, and market value added. Of course, federal tax system. So balance sheets, and we see short definition of each of the component of financial statement. Balance sheets provides a snapshot of a firm's financial position at one point in time. So the balance sheet we see for a company, if we talk about McDonald's, just select the balance sheet or financial statement of McDonald's for 2022, you will see that report, that statement actually made for only 1 year, 2022. Income statement actually summarizes the firm's revenues and expenses over a given period of time, meaning 1 year. How much company sales actually has been in that particular period, and what are the expenses that occur to achieve that sales. Statement of cash flow, this is kind of a statement that reports how company receives cash flow from different sources, and how company experience cash outlay to different sources like investment or paying financial debt. Owner's equity, this is kind of summary position of stakes or holdings by stockholders for a particular time period. um, Balance sheet structure, actually from our accounting perspective, balance sheet statement actually contains those two sides. One is asset, another one is liability. And the way every assets or every liability is presented uh, from short term or current or liquid to the long term and fixed asset or liability. Consider this one. Current liability, this is the most liquid on, then long term, this is less liquid stock owner, this is actually not liquid as much as long term debt or current liability. On the other hand, current asset easily convertible to the cash, but long term fixed asset not easily convertible to cash as we can do for current asset. And then meaning most liquid to the least liquid asset, we can say most liquid or short term debt to the long term debt. That way all the items in our balance sheet actually presented. Say one of the company's financial statement, we have several remarks. Let's see balance sheet. So this is our comparing balance sheet. Cash, the most liquid asset, account receivable, another liquid asset, inventory, another liquid asset. So these all together we have current asset total, then fixed asset, less depreciation, and then after depreciation we have net fixed asset. So um, this net fixed asset and net current asset, this current asset, we together we have $2 million total asset. This is for 2021 and 2022. On the other hand, liability, we have the least liability, short-term debt, accounts payable, accounts accruals, and notes payable. Total current liability is this much, and then long-term debt, common equity, return earnings. Those are long-term debt from company perspective. Total equity is this. So this and these two together, we have this total liability and owner's equity. So these two should be exactly same. $2 million and then $2 million. And income statement, see what are the items included in the income statement. So remember, income statement is all about sales. How much sales revenue generated for a particular point of time period by a company, and what are the expenses incurred to achieve that sales. So this is our sales, cost of goods sold, how much expense has been incurred to achieve this amount of sales, and then what are the related operating costs to make this happen. At the end we have net income. So negative figure, if we end up with negative figure, our number should be within parentheses, meaning this is accounting format, and this is positive. So positive meaning profit, we made some income out of our expense. Then other data, these are just analysis data. How much is the EPS, how much is the dividend per share, stock price, lease payments, number of shares. These are some additional information. And statement of stockholder equity, meaning the summary position of stockholders holdings with that company. This is of course year to year, 2022 to 2021, like this. Statement of cash flow, this is all about our finance. Statement of cash flow, we consider the cash flows from three sources. Number one is operating sources, then number two is investing, number three is financing activities. So how much money we have from operating expense. So the last one, then this is negative, meaning we, for that particular period 2021, we haven't received any amount of we didn't receive more cash than we actually experienced cash outlay, meaning cash inflow occur less than cash outflow occur. So we spend more to operating activities last year. What are our investing activities? Investing activities is negative, meaning we invested more, cash outflow occurs. Financing activities is positive, meaning we borrowed money, cash inflow occurs here. So that way, summary is net decrease in cash. This at the beginning was this. This is the ending balance. How much cash holding right now for that period? So 7,282. Okay. So these are some narratives, and we have some formulas to analyze financial statement of a company. Net working capital, meaning how much money you need to have to support your operations. Formula is current asset minus current liability. And net operating working capital, C, operating current asset minus operating current liabilities. So the operating, working, and current asset, only difference is those assets are in operation or not. Net operating working capital, current asset minus excess cash, current liability minus notes payable. So these are the formula we will see when we solve our some homeworks problem. Practice, okay. So we can analyze by applying our formula, and then we can see. So basically you need to sharpen your memory on the components of financial statement that includes balance sheet, income statement, cash flow, and owner's equity statement. So these four components, and what are the items included in each of these component, then how they are formed, we'll see. So free cash flow, this is another concept, meaning how much cash financial manager has for the time period to invest, to support further investment. So these, if we get this number from balance sheet or financial statement, then we can calculate, okay, for that year financial manager of that company will have this much free cash flow, meaning has no cash flow actually. But if the question is negative free cash flow always a bad sign, what would be your answer? Think. Answer is no, because negative free cash flow meaning company invested more in some investment projects. So if company invested some more cash in investment projects, meaning in the long run company will receive more money in coming. So that's a good one. Okay, so if you apply this previous formula to get the free cash flow from for this problem, try and then calculate the free cash flow for this one using the formula. Okay, so this is one page balance sheet, asset, and then total liabilities 131. This is another company, 131 income statement. So what would be net operating working capital? So this is our formula, and this is the thing you need to do. So in this chapter you need to understand what are the individual component that presented in financial statement. Then we can analyze the financial position or the potential of future cash flows of that company, and that will help us to evaluate our investment. If we consider from investment perspective, if we consider from managerial perspective, then we can say what are the actions manager should take that will lead to future more cash inflows to the firm. That way the company valuation would be higher. Okay, some performance measure, we have two: market value added and economic value added. So just think difference between market value and book value of firm's common equity. So book value meaning the valuation of a company we can do based on the fundamentals, meaning accounting performance. That's our book value. Market value means how investors actually think of that company's value, meaning what are the stock price right now, and what are the stock price based on our calculation is the book value. So if market value is more than book value, meaning investors actually value that company more than its intrinsic price. So that's a good one, we want that. So number of shares times price per share minus book value. That's our calculation formula for MVA, market value added. EVA is kind of economic profit, meaning how much is your net operating profit after tax minus how much money you need to pay to the debt holder. I mean the interest expense amount. That will give us economic value addition. So these are the two concepts we need to solve our some homeworks problem for this chapter. Okay, so rest actually nothing much, just you can read and see. Let's solve some of the problems. Individual tax one is just you need to see what are the tax break like this and then calculate. For our homeworks or study materials on chapter 3, you will see these files. So let's see the related equations from chapter 3. So this is our chapter 3 equations. Mostly we will need to analyze financial statement based on these equations or modeling, we can say. For example, total debt, how much is the total debt? That includes short-term and long-term debt. How we can get FCF, free cash flow, that we already saw. And how is the market value addition or economic value additions, how much is the stockholder equation. So we'll be using this formula to solve our homeworks problem. uh, let's see how many problems we have for this week. Okay, let's see our practice questions. So this is our practice questions on chapter 3. You need to review the balance sheet, how those items are presented, income statement, statement of cash flow, market value addition, and then economic value addition. So we have problem 1, problem 2, 3, 4, and 5. So 5 problems. So let's solve it. And before that, we need to open a Excel spreadsheet. Chapter 3, financial statements, practice problems 8. Okay, if I can show you them in side by side. Okay, so let's see. The first problem is the assets of Dallas and Associates consist entirely of plant assets and net plant and equipment. The firm has no cash, no excess cash. The firm has total assets of 2 million and net plant and equipment equals 2 million. Net it has notes payable this much, long-term debt this, total common equity is this. Firm does have accounts payable and accruals on its balance sheet. The firm only finances with debt and common equity, so it has no preferred stock on its balance sheet. So the number we have from our problem, let's try to input here P1. First of all, say current assets is how much? 2 million. 2 million. I'm sorry. Total asset is this, net plant and equipment is 2 million. So this should be net plant and if we say this, so we don't know, say total assets is how much? 2.5 million. This is our total asset. Then current asset would be how much? So this minus this. So this number we can get from our problem. This number we can get from our problem, but this one we generated or calculated. Okay, now on the liability side, we have AP, accounts payable, and accruals. Accounts payable and accruals. I should type P in a bigger letter. Oops. Okay. Notes payable, no. Long term, we don't know. So notes payable. Notes payable is how much? 150. No, 150,000, not million. Then these two together will be our current liability, and then now we have our long-term liability, that is 750,000, and then common equity. Common equity is 1.5 million. Okay. This information we have. So since both sides we should have equal amount of balance amount, so total liability and owner's equity would be exactly this one. This is our derived one. If summation of all this, say how much would be the actuals? This minus this minus this minus this, so $1 million. Then current liability would be, this one is derived one. Current liability is summation of this plus this. This is also derived one. Then common equity, we should say total common equity is this. Okay, so here you go. This is our statement. The value we can get from our problem. This is our financial statement. We can say this is total asset size. This is total liability and owners equity. Now say one. What's the company's total debt? So total debt meaning what? Total debt meaning short-term and long-term debt. So what's our short-term and long-term debt? So total debt equal short-term debt plus long-term debt. So our long-term debt is 750 plus short-term debt is this. Done. So 9 million. Now second one, what is the amount of total liabilities and equity that appears on the firm's balance sheet? Total liability. See total liabilities and equity. So total liability, can you just say total liability? Total liability, can you just say this one? LN owner's equity. Exactly same amount. Nothing you don't need to change. Then three, what is the balance of current asset on firm's balance sheet? Current assets. Current asset, can we say current asset? Current asset is this 500 million, like this, 44. what is the balance of current liability that firm balance sheet has? Current liability. How much is our current liability? Exactly 250. Then problem 5. What's the amount of accounts payable and accrual on its balance sheet? Accounts payable, accruals. How much is our accounts payable and balance sheet? Exactly $100,000. Then 6 is what's the firm's net working capital? NWC, net working capital meaning current assets minus current liability. So remember, our current assets is this minus current liability is this. So 250. Then 7. What's the firm's net operating working capital? So operating working capital, operating working capital. How is our operating working capital? If we go back to our operating capital formula, so this one. So operating working capital meaning current asset. So current asset, we don't need to type the formula. So current asset, parenthesis start, current asset minus excess cash. In our problem, we don't have any excess, no excess cash. So this one is 0. Then go to the formula sheet, minus this, minus parenthesis begins current liability. This is our current liability minus notes payable. So how much is our notes payable? Is this. That's our $400,000 would be our net operating working capital. I'm using the formula and just Excel calculation. I frequently told you to watch my Excel video to see how I'm calculating. Okay, so this number should be yellow color. And yellow color means the number we just got from the problems. Okay, do we have one more problem? 8. 8 says, what's the explanation for the difference in your answers to parts F and G? Not F and G, it should be the previous one, the working capital and not operating working capital. So the answer is lies in the formula itself. So see how working capital, current asset minus current liability, how net operating working capital. So the difference actually we see just because of notes payable. Excess cash we don't have, so notes payable we included in our calculation. That's why we have $400,000. So the difference actually comes from the formula itself, nothing else. Now let's move on to problem 2. P2. Problem 2 is asking what? Byron Books Incorporation recently reported 15 million of net income. So let's type this. Net income is 15 million. Then EBIT is 20.18 million. Tax rate is 25%. And then what's the interest expense? Interest expense equals what? And divide, I don't know how this one. Okay. So since this is this value we just get from our problem. Okay, let's form income statement. Income statement. As the first thing we have, we in our income statement we have sales. After sales, we deduct our EBIT. Sorry, we deduct our cost of goods sold. Then we can get EBIT. EBIT is this. Then we deduct interest. Expense that we don't know. Now, then we have EBT. So EBT is this minus this. Then we pay tax is 25%. So this times this, and then our net income. Net income actually remains this minus this. But remember, we have net income is this. So if tax is 25%, then how much would be actual tax? This times 1 minus tax rate, 75%. No, I'm wrong. So the the pre-tax income should be equals this minus times 1 minus tax rate. So this should be our pre-tax EBT. So and this is our, so why it is not taking, oh, and now interest expense would be this minus this 950. Okay, now this is our solution one. Solve. This should be this, since we have this value. EBT, I mean NI is this. Now consider EBT. So from EBT to NI, what we did, we deducted 25% tax rate. So if we just need to go back, then we need to divide this by 1 minus this one. So that's our EBT. Now, what's our interest expense? So interest expense should be this minus this. So this would be our answer. You see, $800,000. Okay. Now let's go P3. So P3, it says Hampton Industries had 39,000 in cash at year end 2020, 11,000 in cash at year end 2021. So say cash 2020, 2021, 2021, how much we have cash? 11,000. Then 2022, 39,000. So that's the value we can get from our problem. Okay, then the firm invested in property, plant and PPNT, $20,000, $210,000, and then useful life, is 20 years. Useful life greater than 20 years. Okay, falling under alternative depreciation system, cash flow financing activity, total plus cash flow from financing is 120,000 plus. Now, what's the cash flow from operating activity? Operating activity. So, as we said, cash flow statement contained three items: cash flow from operations, cash flow from investment, cash flow from financing. So this is our cash flow one. Let me make it different color. Okay. Now, since we have cash flow in 2020 and 2021, so how much is the changes in cash flow? So this minus this, actually this value we got from the formula, and this one is the our derived one. So all this value is from formula, and now we are going to um, calculate. So net cash, I mean net cash, or we can say changes in cash. Changes in cash must be this one because this is year to year. So, and summation of these three would be this. How much is our cash flow from financing? Cash flow from financing is positive. Now, cash flow from investment is also negative, right? Since this is our investment. And how much would be the cash? So, this should be this minus this minus this, $62,000. This is our cash flow from operations. This is our answer. This is part 1 actually. Then part 2, or even I can minimize this. Okay, part 2 says if accruals increase by $15,000, receivables and inventories increase by $50,000, depreciation, amortization total $25,000. What is the firm's net income? So cash flow from operation, do we have our formula? Cash flow from operations, not really. Okay, so see, cash flow from operation, in other words, we can say the problem is asking about estimating free cash flow. So these equations we can use. This is net income, depreciation, accruals, then accounts receivable, increase in account receivables. That's where we can say cash flow from operations. So since cash flow from operations, we need to calculate. First of all, we need to get the net income. How much is our net income? Do you know? We don't know. Cash flow from operation is how much? 62,000. That's our cash flow from operations. Now account changes in account receivable. Account receivable, it says the problem one. the account receivable increased by $50,000. So 50,000, and then this should be, this is our calculated value, and this should be okay. Account receivable increased by 50,000, accruals increased by 15,000, and then depreciation was 25,000. So see how we can get cash flow. So net income minus net income plus depreciation plus liability minus account receivable. So other way we need to get this one, net income equals plus depreciation plus increase in accruals minus increase in AR. So if this is our formula, so cash flow equals this, then how we can get net income? So we just need to send everything back, like NI equals cash flow from operation minus depreciation minus increased in accruals plus increase in AR. If I move here, so then we should say this minus depreciation minus this plus this. So this is our net income, and these three value we get from our problem. So this is your answer, net income. So for your problem, you just need to change the number in yellow cells, and then you will get the answer in green cell. Then problem 4, P4. This is market value addition. So market value addition, if we go back to our formula sheet, market value addition, number of shares outstanding time price per share minus book value of total common equity. So what's our problem? Harper Industries has 9 million of common equity in balance sheet. In its balance sheet, its stock price is $80, and then market value added is 50 million. How many common shares are currently outstanding? So again, if this is our formula, EVA, so get the values first. Outstanding shares outstanding is how many? 900 million. Then price per share is $80, and then MV is 50 million. Then what it is asking? Common share outstanding. Oh, this would be the book value. Shares this. Then how much is our common share outstanding? So this value I just got from our problem. So let's copy our MBA formula. MBA equals P times shares outstanding plus, sorry, minus book value. So then can we just type MVA plus book value equals or MVA plus book value minus P equals outstanding, or you can say MV. So MV of this plus book value is this, divide P is this. So 11 11.87 million shares outstanding. That's our answer. This should not be in yellow color. Okay, then P5. Barton Industries has operating income for the year of 3.5 million and 25 tax rate. Its total reinvested capital is 20 million. Its after tax percentage cost of capital is 8%. How's the EVA? So operating income EBIT 3 tax 25%, and then invested capital is 20 million, cost capital is 8%. So these all values we get from our problem. Now what's the EVA? Let's go get the formulas. EVA equal EBIT times 1 minus T minus invested capital times. Okay, now our formula EVA is this, so we can get equal sign, parenthesis start, EBIT this times 1 minus tax rate. This should be first part minus second part, invested capital is this, times after tax percentage cost of capital. So times 8% is after tax cost of capital. So this one. So this I should type after tax. Okay, so this is our EVA. I think this all from our chapter 3. Hope this will help your Sange's homework assignment for chapter 3 in this week. Good luck. Thank you.